Don't let valuation concerns prevent you from buying Apple stock. A Fortune contributor complained about Apple's valuation. Nevertheless, Apple has punished the bears and short sellers and probably will continue to do so. Investors should expect Apple stock to offer good value despite the naysayers' objections. Let's dive in. Here's why the warts are wrong about Apple stock. Welcome to Timely Investment Research. Should investors lose sleep at night because Apple stock looks overbought? Historically, betting against Apple hasn't been a profitable trade. Even after booking huge gains in 2023's first half, Apple's shareholders will probably continue to enjoy decent returns in the coming quarters. This doesn't mean that the year's second half will be mind-blowing like the first half was. Admittedly, the pace of future returns might slow down somewhat. Apple remains a best-in-class technology company. A warts complaint about Apple stock. Here's a headline that's bound to raise some eyebrows. Hopefully, it won't prompt investors to panic sell their Apple shares. According to Fortune contributor Sean Tully, now could be the worst time to buy Apple stock. The author cited the cyclically adjusted price-to-earnings ratio, or CAPE ratio, which was developed by Robert Shiller many years ago. As Tully explains, the cyclically adjusted price-to-earnings ratio adjusts for cycles in earnings-related environments, such as when earnings are either enjoying an unsustainable boom or stuck in a temporary rut. Presumably, Apple would fall into the unsustainable boom category. There's no denying the boom part. After all, Apple stock has rallied from $125 to $190 this year so far. But does Apple's high cyclically adjusted price-to-earnings ratio of 30.9x mean that the stock's first half of the year 2023 gains are unsustainable? There are plenty of other valuation metrics besides the cyclically adjusted price-to-earnings ratio that the warts could cite now. However, Apple has been overvalued for a while, several months at least, but the stock has continued to march upwards. Apple stock just keeps on climbing the wall of worry, and it even seems to gain momentum from the bears' fear. Apple's investors typically win in the end. Instead of worrying about Apple's valuation according to traditional metrics, consider this. As long as Apple continues to grow as a business, it can offer value to long-term investors. That's why Apple's shareholders generally win in the end. Tully admitted that Apple's inflation-adjusted earnings per share grew from $1.82 in fiscal 2013 to $3.75 in 2020. From there, it increased to $6.08 in 2021, and then $6.11 in 2022. For growth-focused investors, that sustained pace of earnings growth suggests that Apple stock's gains aren't necessarily unsustainable. There's evidence that despite the rise of inflation, shoppers have continued to buy iPhones in huge quantities. Specifically, Apple's iPhone sales in the United Kingdom surged to a record £1.5 billion during the 12 months ending in September of 2022. In the US, the iPhone's market share reportedly increased from 49% 2022's first quarter to 53% in the first quarter of 2023. No need to lose sleep over Apple stock. In the final analysis, Apple has earned its place as a member of the Magnificent Seven. Apple stock is among the best-performing publicly listed technology stocks in 2023 so far. Shoppers are still buying Apple's products, and especially iPhones, in large numbers. The company's long-term earnings per share growth has been outstanding. Unless there's negative sales or earnings data soon, there's no compelling reason to worry about Apple stock. The future returns should be decent for Apple's shareholders, even after a powerful first half of the year rally. Thanks for spending some time with us today, Timely Investment Research. We're so glad you did. If you found value in today's video, please give us a like, hit that bell icon to never miss an upload, and hey, don't forget to subscribe.